Hey everyone, I'm Bob Jablonsky. I'm an enrolled agent and tax resolution specialist. If you owe the IRS more than you can afford to pay each month, but you don't qualify for an offer in compromise or a settlement, the IRS has another option that can potentially reduce the total tax you will pay over time. And a lot of taxpayers have never heard of it. It's called a Partial Pay Installment Agreement, or a PPIA. And in today's video, I'm going to break down exactly what it is, how it works, who qualifies, and the pitfalls you absolutely need to avoid. So what is it? A partial pay installment agreement is an IRS program that lets you make monthly payments, but unlike a normal installment agreement, if you make the payments as agreed upon with the IRS, you don't have to pay the full balance before the collection statute expires. In other words, you pay what you can, and when the statute runs out, the rest of your IRS debt is legally forgiven. Think of it as potentially backing into a settlement. So when does a PPIA or a partial pay installment agreement make sense? You might benefit from a PPIA if you can't afford a regular payment. You don't qualify for an offer in compromise. Maybe you have some assets that make the offer just unrealistic for you, but not much income. So you're someone who can afford something each month to pay to the IRS, just not enough to pay the debt in full. This program is kind of you pay what you reasonably can and we'll write the rest off later. So how does the IRS calculate your payment under a PPIA? The IRS will look at it based on your monthly income versus your allowable expenses paid out monthly, your inflows less those outflows. Whatever is left over when you take those inflows less those outflows, that's going to equal your monthly payment. For example, if your income minus your IRS allowable expenses is $150 a month, then your PPIA is likely around $150 per month. So one thing that's a little different about this, or actually it's very different, is that a PPIA is going to require a financial disclosure or a collection information statement, which comes on a Form 433. So if you're dealing with a revenue officer and you're talking about income taxes, it might be a 433A. If you're dealing with income taxes with automated collections, the 800 number you call, it may be a 433F. Or if it's a business, it may be a 433B. But you will be required to provide these financial disclosures to be approved. And that financial disclosure is going to have detailed information of income and expenses, as well as the assets that you own. And they're also probably going to require bank statements from you and pay stubs and proof of bills, ways to validate the information that is on that disclosure statement. This is not like a simple online payment plan. It's detailed, it's going to be scrutinized, and you want to make sure the numbers are correct. Your assets are going to be evaluated, but unlike with an OIC where it directly affects the amount due, that's not going to be the case with a PPIA. The IRS typically does not require you to liquidate assets for a PPIA, but if there are substantial assets, it may factor into their decision of whether they approve it or not and or the amount of the payment. So because this is a special agreement, the IRS is going to be reviewing your financial data after you go through this process, after you're approved. So it's not a permanent status. They're going to review your financial situation over time, and they may contact you directly, or more likely, they're going to be monitoring your tax returns for changes in income. If your income goes up or your expenses go down, the IRS can increase your payment within that statute of limitations where they can still collect from you. They're also going to make sure you're filing your returns and you're not owing more. Those things could create a problem with your PPIA and make you start over again. So what are some of the common mistakes that get PPIAs rejected? Well, you might be claiming expenses that the IRS doesn't allow, or claiming expenses in excess of the standards that they permit. You might be providing poor documentation. You're going to have to do a good job of documenting your request so that they are able to approve all of your expenses. And you need to include all of the information, the income, the expenses, and all of your assets in order for them to evaluate it. So if the IRS believes you're not being accurate, whether it's accidentally or on purpose, they can and they probably will deny the agreement or force a higher payment than is really necessary. So let's wrap this up. A partial pay installment agreement can save you thousands, tens of thousands, or even hundreds of thousands of dollars, but only if it's set up correctly. If you need help figuring out whether you qualify or you want a professional to handle it for you, schedule a consultation with us using the link below or by calling 972-821-1991. And if you found this helpful, hit like, subscribe, and drop a comment with any IRS topics you want me to cover next. Thank you for listening and have a great day.